My name's Ben Mashter. I'm Access to Funding and Finance Manager from Innovate UK EDGE. Welcome to our second Thought Leadership Series, Innovate 2021, looking at enabling ambitious, innovative SMEs to overcome challenges and build for growth. We have a series of webinars and workshops running throughout the spring, covering everything from funding and finance to leadership and strategy and sales and marketing. Each event promotes broad but bespoke support available from Innovate UK EDGE and demonstrates how we can add value to your future growth plans in this challenging environment. A few housekeeping rules now. If you've got a question, please use the Q&A box. If you raise your hand if you need assistance, and one of the events team will come and help you. The chat function is there to communicate with other attendees, and we won't be watching that. And for on demand, this webinar is being recorded. Your personal video and microphones will not be used unless invited to speak by myself or one of the other hosts. Today's session is hosted by Ruth Bethel, Innovate UK EDGE Access to Finance Specialist. Ruth's long career in finance has included work in domestic and international banking, personal investment, commercial finance, including insurance brokering, access finance, asset finance, I should say, invoice and trade finance. Today, we will cover post-lockdown recovery and growth, finance options to stabilise cash flows. As a participant of Innovate 2021 and subject to Innovate UK eligibility criteria, there is the option for you to access our comprehensive range of services and support. I'll discuss the next steps and how to access these services at the end of the session. I'd like to hand over now to Ruth.
Hello, good morning. Can you all hear me? Can you see my screen? I hope you can. Good. Okay. So hello, you're probably watching this webinar hoping for a bit of clarity about all the options around finance and what could be available for your business at the stage that you are at the moment. So we're going to talk about different sorts of options of commercial finance. We're also going to talk about credit, managing credit. Credit is one of these words that people bandy around, and it has lots of different meanings in different contexts. And we're going to look at what credit means within business finance and how you should manage your credit to look after your cash flow. Cash flow forecasting is another word or phrase that people use a lot. And often people think it means just for big businesses, but it isn't. It's for any size of business. So we're going to run through some basics with that. Okay, so let's start. Right, technology screen for moving forward. Sorry, right. Okay, so the first thing we're going to look at is the government support that's available to businesses today. And that covers both central and local government support. We're also going to look at commercial finance options. Most of these I've practically worked in, so hopefully if you've got any questions, I can give you some practical real life answers. So we're going to look at asset finance, invoice finance, trade finance, and if you're wondering what are all these, it will become clear. So we're going to look at managing credit and forecasting your cash flow and why that is so critically important for you. Okay. Now a poll. So if you could all just answer that, that would be really helpful. So we get a little idea of anything that you've used before. Right, interesting. Okay, so quite a few of you have used the bounce back loan. Also, quite a lot of you have used none of these things at all. Trade finance is the least, and very interestingly, 17% of you have used invoice finance, asset finance, and CBILs, all on 17%. Interesting. Right, sorry. Okay, so we now move to government support and talk a little bit about what is available. So we have the bounce back loan, BBLs, and this is for any business that basically is needing to bounce back from the lockdowns. And you can borrow between 2 and 50,000, and you can apply up to March 31st of this year. You do need to, you will be limited to amount you can borrow. Although it says up to 50,000, it's limited to actually 25% of your previous turnover or double your previous year's wage bill. Now, if you're a small business that was established before the 1st of March last year, so in other words, if you've been going just under a year now, then you can estimate your turnover. The Coronavirus Business Interruption Loan, CBILS, which has the acronym CBILS, everybody calls it CBILS. This is for larger amounts, 50,000 to 5 million. Again, it's been extended to March the 31st. And the next thing we have is, this is very recently been launched, the BBLs top up. So this was launched just a bit before Christmas on the last lockdown. So any business that didn't originally borrow as much as they could have done. So if, for example, your turnover was, let's say, 200,000, so you could have borrowed 50,000 and perhaps you only borrowed 10, you can now apply to borrow the other 40,000. The other 40,000 will need to be repaid at the same time. So the repayment period, which starts 12 months from the original drawdown date, is not extended. So if you borrowed last June, for example, and you have to start paying back this June, you will still have to pay back this June, even if you top up. Okay, hopefully that's clear. Great thing about the bounce back loans is the interest rate is so cheap at 2.5%. A real steal. So really, if you're eligible for it, I would say to all businesses, if you're eligible for it, borrow it, put it in a separate deposit account, keep it away from your normal day-to-day running money, keep it as an emergency. If you don't use it within a year, then pay it back before you have to start repaying anything, and it won't cost you a penny, but you'll have an emergency backup. Okay, so the latest additional support is that the government has launched something called Pay As You Grow. The idea being that businesses are going to grow once we come out of lockdown. So you can delay your repayments for another 6 months, and you've got the option of extending the loan repayment for up to 10 years. So it's going to make repayments very, very, very much cheaper every month. And there's all sorts of flexibility bits that they've put in, like you can make interest-only payments for 6 months, you can pause repayments for 6 months. And they used to say that you had to pay for six repayments before you could pause. Now you only have to make 1 repayment. So if you're really strapped for cash, just pay back 1 repayment, and then you can have 6 months holiday while you gather yourself together and trade on, hopefully through the summer. If you haven't got a BBL, bounce back loan, your lender should start contacting you, if they haven't already, to discuss the different options. If they don't contact you and you want to see what you're entitled to, then do contact them. CBILS then. Okay, so CBILS, again, the application, the time to apply has been extended up to the end of next month. So you've got another 5 weeks if you want to apply. So don't hang about if you do, because lenders are very, very busy. So don't wait until the last minute. Otherwise, if you wait till the last minute, you're likely to get turned down. Again, repayment terms are up to 6 years. First 12 months interest free. Now, the great thing about CBILS is if you took one out last year, you can refinance it with another lender and give yourself another 12 months interest free and no repayments, because the interest and capital repayment holiday starts again from the date of the new loan. So if you say took a loan out with XYZ Bank last year, you can go now to ABC Bank and refinance it. You get another 12 months before you need to pay a penny back. Hopefully that's clear. Right, support locally. Now, we're talking about quite modest small grants here, but businesses in retail, hospitality and leisure, so pubs, clubs, cafes, shops, gyms can all get a one-off grant worth up to £9,000. So that's the closed business lockdown payment. There's also rate grants. You do need to look at your local council's website for information, and you have to apply to your local council. The council does get the money back from central government, but you have to apply to them to start with. Right, commercial finance now then. Okay, asset finance. Now, I expect most people are familiar with this sort of finance. So this is to fund tangible assets, generally, in the main anyway, things that you can see and touch, like plant machinery, computers, tools, all sorts of stuff to say that you can actually see. So there's various ways of financing these. You can sometimes fund what they call soft and intangible assets, more and more these days as we get more and more technical, but they're usually as part of a general package. Okay, so you've got hire purchase and leasing here. I'm not going to get too much into the technicalities, but with hire purchase, that is where you pay for an asset, whatever it is you're buying, a piece of machinery, piece of kit, vehicle, pay for it, and at the end, you own it. With leasing, you don't automatically own it because it is the property of the finance company. When you've paid back what they call the primary term and the agreed payment term comes to an end, you may have an option to buy. There's different tax treatments for HP versus leasing, which is why we have the different options. Some businesses will be better off with one, some better off with the other. In general terms, if you're profitable, you'll be better to have HP because it's more tax efficient. But you should speak to your accountant about this. Your accountant will be able to tell you which option is best for you. And do always look at the tax, see how much you're going to pay, see which is better for you. We all have to pay tax, but you shouldn't have to pay any more than you've got to. Invoice finance. Right. Now, invoice finance is for businesses that sell goods or services to other businesses. So you need to actually be trading or planning to set up trading in the very near future. And you need to give your customers time to pay. So in other words, you're selling on credit. So the idea of invoice finance is that if A is selling to B and B wants to pay at the end of the month following. So in other words, say if you delivered something today and the person that you're selling it to or the service that you're providing doesn't want to pay till the end of next month, you've got to fund all your expenses, maybe wages if you're employing somebody, and your rent, rates, whatever, and live before, for the whole of a month until you get paid. Might even be 2 months if people are late paying. So the invoice financier will advance a percentage of the invoice to you. And then you can pay all your expenses and your overheads. And then when the goods or services are due to be paid for, the customer will generally pay the invoice financier. Sometimes they pay you, it depends on the arrangement you have. But your customer will pay, and then you get the rest of the money less the modest charge. So sorry that jumped. Right. Okay, so back to invoice finance. Sorry about that. So factoring or invoice discounting. You might have heard these two terms. Factoring is a full service where the financier does the credit control and account management. And this can be absolutely great for smaller businesses where people struggle to do all their admin as well. It also removes the worry of you having to do the credit control and ask people for money at the same time as trying to sell them things. It removes one step away, and it takes a lot of admin off your plate and makes life a bit easier. Discounting is aimed at slightly bigger businesses where they usually have an accounts office and somebody doing the credit control, either full or part-time. And then the discounter the financier just advances the money, the client collects the payment themselves and accounts to the financier for the money. Right, loans and overdrafts. Okay. Okay, traditionally, these are provided by the big banks. Not all high street banks these days. We've got a lot of challenger online banks like Starling and Monzo and people like that. Usually a business has to have a current account and run it for a little while before being considered for a loan or overdraft from a bank. And the sad reality of life is that the less you want the money, the more keen the banks are to lend it to you, which is, I'm afraid, a fact of life that we all have to live with. Banks will want to see financial accounts and they will want to see forecasts. Most banks also do want directors to give personal guarantees, unless it's a very small overdraft, up to sort of 10,000, perhaps even 20,000, they're not too bothered. But if you want to borrow more than that, they will expect a director of a limited company to be personally responsible for it. The great thing about an overdraft, if you can get one from your bank, is that they are very, very flexible. Probably the most flexible form of finance you'll ever have, because it's just money available to you in your bank account that you can use when you need it. And as long as you make sure you don't build up a lot of overdraft and get completely up to your overdraft limit, and you're always overdrawn. That is the problem with overdraft. But if you use it sensibly, it's very, very flexible. Now, this is something perhaps a little bit different for some of you, merchant cash advances. Now, this is for businesses in retail or leisure sectors. So this is what we call B2C, so business to customer, business to consumer. So anybody that has a business where most people who buy from you are the general public, the consumer, and they pay by credit card, this sort of finance is for you. So if you use a card terminal to take payments, the lender, for the merchant cash advances, the lender will get an idea over 3 or 4 months of how much on average you take through your card terminal. And they will then make a decision on how much to advance you if you need a loan. Typically, they will advance you about a month's taking. Then you pay it back automatically because they take a percentage of everything that you take through your card terminal. Okay, does that make sense? So say if you've got a shop and people come in and buy, let's say, £10,000 a month, then you get a loan of around about £10,000 and pay for it over a year or two as a percentage of your cash takings in future months. Hopefully that's fairly straightforward. Trade finance is another slightly different one, but I did see that 17% of you have used that, so it's not too weird. So this is for both domestic and international transactions. A lot of people think trade finance is just for overseas transactions, but it isn't actually. All you need is, you need 3 parties. You need a supplier of goods, and this is for goods. This is not for services, this is for goods. So you need a supplier of goods, you need an eventual buyer of goods, and you need somebody in the middle who is, for example, you. So if you're the client and you're buying goods to sell on to other people, then you often can't afford to buy your goods before you get the money. So what happens is the trade financier buys the goods, arranges to sell them to your customer then has an invoice from you. The trade financier discounts that invoice, pays themselves back, and pays you some money. The goods do need to be finished goods because the trade financier uses them as their security. So if, for example, your customer pulled out of the deal at the last minute, the trade financier would need to sell them to somebody else. So they do need to be not bespoke, they do need to be general saleable goods. Okay, your business stage. Now, at different stages of your business, you'll be able to borrow or look at borrowing different types of finance or using different types of finance. So if you're a startup or a very early stage business, you'll find there's a government startup loan with a British Business Bank, which we recommend quite a lot because it's very good interest rates, capped at 6% per year. not quite as cheap as the BBL, but still pretty cheap and quite easy to access, as long as you haven't got any previously bad credit. If you've got a bad borrowing record, then you will have difficulties with this. But otherwise, because it's aimed at startups, you don't have to provide accounts. Quite easy application process online. Invoice Finance is also available to small businesses or new businesses, because the invoice financier works on future sales, not on past sales. So again, you don't need to provide accounts going back 3 years or anything like that. Okay, so finance is possible. It does work if you're a new business. You just need to ask for the right people, you just need to go to the right places with the right advice. Okay, established business. As I've said before, the better off you are and the less you need to borrow, the easier it is to borrow. So one of those things, I'm afraid, in business. So consider your credit history. If you've had loans where you've defaulted in the past, then you will find it a lot more difficult to borrow. So that is another reason why you should always only take debt that you feel able to repay. Directors' personal guarantees are generally required. If you're a director of a limited company, it's unusual to say, apart from very small overdrafts, it's very unusual not to be asked for a personal guarantee. So do be prepared that you will be asked for this. Right, so managing credit. So what do we associate with the word credit? Now, a lot of people might think it is whether you've got a good credit record or a bad credit record, but it's also the amount of time you give your customers to pay. So the period of time that you give to your customer between you providing them with goods or a service and them actually paying you. And that is what we're going to have a look at now, because that is very important. So if you run a small business, don't act as the frontline salesperson and the credit controller. That is so difficult to manage, because you're doing the good guy, bad guy bit. So you're, on one hand, you're trying to encourage your customers to buy more or take more from you, do more work with you. And then the next thing, you're asking them to pay because they're late paying. And it's very difficult to tell your customers to be on stop, that you're putting them on stop, but also you want them to buy some more. So employ a credit controller part-time if you don't need somebody the whole time, or you can't afford it, or use an agency, or use a factoring company. A factoring company will take people on whether they want money or not and just do credit control for them. It's a service they offer. When you're looking at your customers, especially new customers, use a credit reference agency. There's Equifax, Experian, and TransUnion. They're not expensive. They can save you a hell of a lot of money, because if you use them and are guided by them, hopefully you won't make too many bad decisions. Do ask new customers for trade references and do check them out. A lot of people ask for them, but they don't actually follow it up. You must do that. And for new customers, if you've not had any dealings with them before, ask for cash on delivery, or even in advance if you can get it, cash with order, even better. Trade on cash and delivery. If you've got to give trade credit to be competitive, then make sure you get a non-refundable deposit. All the time, think of managing that money. You're working hard for your money. Make sure you get it. Okay, so if you are stuck, if you have a lot of people owing you money, use Invoice Finance. It's cheaper to do that and get some cash in than not. And add the costs of that service, which aren't a lot, but add the cost of the service into your costing model, so you're not losing out. You're providing a banking service in a way to your customers, make them pay for it. So, managing cash flow, that brings us on to. Remember this, cash is always king. In my time throughout banking, commercial finance, I've seen a lot of outwardly successful businesses sadly fail because they have no liquidity, no cash available. Lack of cash means that a lot of transactions will cost you more, because you've got to purchase raw materials or goods. in more expensive batches. You've got to pay quickly, you've got to buy things, you have to react to everything quickly, and that always costs more. You have to take on jobs sometimes at lower costs or at cost just to try and cover something, just to get some cash in. If you struggle with cash flow and you take a long time to pay your suppliers, then you run the risk of getting a poor credit reference or county court judgments against you. And also you'll find that if you do pay your bills on time and then something happens, people are far more likely to give you a little bit of slack. If you're a bad payer, then you will find that the trade credit tightens up and up and up as people put the squeezers on you. So if you take longer to pay, the suppliers will tighten up their terms, or they put you on stop, and then you can't fulfill your orders, and then it's a downward spiral. So that is why it is desperately important that you manage your cash flow. So if you take nothing else away from this webinar, manage your cash flow. Okay, cash flow forecasting. So there's something else that I was taught very, very early on: to fail to plan is to plan to fail. So understand your finances. Use a spreadsheet. You don't need to have anything particularly fancy. You can do that if you want to, but just even if you're a small startup business, estimate as much as you can, as accurately as you can, when your payments go out every month. So anything like rent, rates, if you pay staff, wages, salaries, PAYE, national insurance, any loan repayments, your overheads, you know roughly what all these things will be. Work out how much you're going to need week by week, month by month. Look at how much you're going to need to cover these payments, and then work out your profit margin from the sales that you're making, the work that you're doing. Make sure you can cover all these things, and make sure that if you have got a gap somewhere, you arrange finance in advance. Don't leave it to the last minute. So how to work out your costs then? So your fixed costs, these are things that you have to pay every month. Your rent, rates, various overheads, bills. Divide them by your units of work time. So if you work 40 hours a week, divide your fixed costs by 40 hours. Then when you have a job to quote for, you add your additional costs and any labour, any cost of goods, any raw materials, any extra staff you've got to bring in. Add in some contingency. Everything always takes longer than you think it's going to. Things go wrong. Adding your profit margin, and then you've got your price. That's a very simplified model, but it does work. Okay, so long-term jobs, it's more difficult when you're doing long-term jobs, like in the construction industry or project work. You need to agree, you need to pre-agree milestones with your customers for when you're going to pay, or when they're going to pay you. So you need to agree that at the end of every month, or after you've done so many hours work, or once you've got to a certain stage, you will agree that that milestone is being reached. Get everything in writing. And when I say writing, obviously these days I mean emails. Everything in writing, and then every time you reach these milestones, there is no argument. You might need to include something called a divisibility clause, and if anybody needs any of those, I can send them examples. That's a clause in your terms and conditions that says that every invoice stands up on its own right. So they can't refuse payment for invoice 1 because you didn't do something right in invoice 2. Okay. Again, this next point is something that a lot of businesses fall down on. Any extras must be in writing with additional costs agreed in writing. So if you're halfway through a job and they suddenly say, oh, can you add on this? Can you write an extra program here? Or can you do an extra building task here? Whatever it is, get it in writing and agree the cost before you do it. Okay, again, when you've got your spreadsheet on costs, plot your payment dates and your amounts in. Work out how to plug any gaps. So if there's cash flow gap, work out how to do it. Don't wait until it comes. Right, so if you need any finance options or any more personal discussions about this sort of thing, do get in touch with us. I'll hand over now to my colleague.
Thank you, Ruth. That was great. That was really good. I hope everyone found that interesting and insightful. I'll give Ruth a minute now to have a breather, but can I ask if there's any questions to put them in the chat now if you want them answered live? Personally, I thought that was very useful hints and tips there about accessing and when to access the different finance options, and especially the government supported opportunities there that Ruth covered. So I'll give everyone a little bit longer to put questions in the box there. We've had one through already, Ruth, if you've got your breath back.
Okay, yeah, go for it.
So we had a question from Claire asking if you can have CBILS and bounce back at the same time.
No, when you take out a CBILS, you must repay your bounce back loan. That's one of the conditions.
So is it the same if you have a bounce back, then you can't have a CBILS?
Well, once you can have a CBILS, but out of the CBILS, you need to repay the bounce back. Okay, so that's why one of the reasons that the CBILS are larger than the bounce back. So if you've got a bounce back of say 20,000, you take out a CBILS of 50, you repay the bounce back, so that gives you an extra £30,000. That makes sense.
Yeah, I think that makes perfect sense. There's something come through in the chat box, not the Q&A box, but thank you anyway, Gervais. Can you use factoring invoicing retrospectively? Gervais asks. It's okay, Gervais.
Depends what you mean by retrospectively. If you mean if you've got invoices, if you've got money owing to you, then yes, as long as it isn't over 3 months old. So if you've got a sales ledger built up with invoices that are owed to you, less than 3 months old invoices, then yes, you can, certainly.
So 3 months is the thing, though, is it? Okay. We've had a question in from Jane. Oh, is it a comment? It's just Jane saying thank you. Really useful information on complex areas.
That's nice. Thank you, Jane.
And Tassin has asked, can a company get CBIL if no revenue year to date, but costs are mounting?
If you're not trading, no, you need to have been trading for 2019. So bounce back is fine if you haven't got any trading history, but CBILS, you do need 2 years trading history.
Because it's a bigger amount of money, I guess.
Yes, yes. And the idea is it's for business interruptions. So it needs to be for businesses that have been trading reasonably successfully and then they're interrupted by the pandemic, whereas bounce back can be for young businesses that hadn't really got a chance to get off the ground. So it's, it enables them to bounce back. But they say the CBILS is the business interruptions. So the idea being that it's already an existing trading business that was drastically interrupted by the coronavirus pandemic.
Great, that makes perfect sense as well. So we've got a question in the chat box from Jane here. Can Ruth and/or finance support be accessed to businesses on a one-to-one basis?
Through our finance hub, yes.
Well,
yes. So you need to go on business. You need to go online to Business West and go on to our finance hub, and then there's a contact us bit. And if you send through a message, you can get through to us.
Great, thanks. I think there's also, I'll cover this in a minute, but you can access the Innovate UK EDGE support as well, which provides these services in a much more bespoke way. So I'll just mention that quickly now whilst you're covering that as well, Ruth.
Sure.
But I had another question as well. Do you think a company should always approach their current lender for some of the finance options you mentioned, or is there a potential advantage to look further afield?
I think there's definitely a potential advantage to look further afield. I would always recommend that businesses use a good broker. If you're looking for something like CBILS, it won't cost you anything anyway because the government pay the setup fee, but a broker will know the market and they will know the different lenders that like the type of industry, because different lenders have got sweet spots for different sorts of industries and different sorts of businesses, and the broker will know the market, and they'll be able to find you a better deal.